Investing has never been this hard. A brutal but honest admission of the current market conditions. The S&P 500 has had its worst start to the year since 1970, with analysts predicting a further 30% drop in the market to come. Property prices are sky high, with a possible impending crash coming. Mortgage rates are through the roof, inflation is soaring, plus we've got ridiculous energy prices. And while all of this going on, our own government sits around making strange noises, firing each other, passing blame, hiding from us, and having to backpedal on all the things they've screwed up on. If you've just started this year, it's probably been pretty grim and probably put you off investing for life. This is a huge issue in investing and encouraging people to start. You hear about investing, try a small sum to test the water, and it goes down and down and down some more. And before you know it, you've had enough, you've given up, and you want to try something else. As much as people will preach to you to keep investing and to keep going, seeing red after red each month, as much as people try to sugarcoat it, isn't nice. What I want to do in this video is talk very openly and honestly about why it's so difficult, and share with you what I'm thinking about each of the investment areas. I'll give you ways around each of these problems and what I think you should do going forward. Because as always, I want to be as transparent as possible with everything I share. Let's start with what I think is the biggest problem for most of us, the S&P 500. And the problem extends way beyond the S&P 500, as a majority of us will be using the world index funds, like the Vanguard All World Fund, which has a whopping 60% of its fund allocated to the USA. So if you've got this fund, don't think you've escaped the problem. Now the problem comes in two parts. The first part of the issue is the S&P 500 has had an incredible bull run over the past 14 years. Even if we look at the crash of March 2020, it's almost non-existent on our timelines. The market is down significantly this year, which is great. But if we look slightly back in time and you bought in July 2000, you could have held those shares until January 2013, 13 years later, and not made a profit. The solution to this is averaging in along the way and really making sure you have the cash to do so. I know one of my biggest mistakes has been when I've not averaged in, to take advantage of those lower points in the market. It's really easy to get carried away because we see it's down and we buy some more, but it's very easy to dry up your cash reserves. So make sure you've got a plan to buy in steadily. And while I do like the idea of dollar cost averaging, it's not without its problems. There's times in the market where it seems very clear it's not a good time to buy. People laughed at investors who decided to stop buying at the beginning of the year. I swapped to building up cash positions over the past 6 months, which has been hard with a temptation to buy, but it's worked out in my favour, as I would have just continually bought and lost along the way. But this also creates another problem, because you could continually sit and be waiting for the bottom. Most analysts now are expecting the S&P 500 to end up around 3,000, another 10% dip, but no one knows for certain. The problem is the S&P 500 has looked too expensive for quite some years now, and it's always great headlines that a crash is on the way. If you believe this to be true, then an inverse ETF may be a good option to consider. Recent research by Freetrade showed that the second most popular buy within an ISA was an inverse S&P 500 ETF. This essentially means you'll make profit if the S&P 500 falls. While that's good if it works, I don't like this approach of timing the market. I'd much rather just hold cash so it doesn't backfire on me. And I've always liked the idea that Warren Buffett holds such large cash positions. Trying to time the market creates stress and anxiety in itself, and it makes a set and forget approach seem way more appealing. But although the market conditions bother me, the more alarming issue is just simply the exchange rate. I made a whole video explaining this, but the dollar is very expensive, which makes buying shares expensive. Fine if the rate stays where it is. In fact, the dollar getting stronger has actually helped us when we look at the past, as we get more pounds for our dollars when we sell. The issue comes if the inverse happens and we get more pounds for our dollars. Although our government has done an awful job of demonstrating it, their number one concern is to drive growth in the UK and stability and drive the price of the pound up. When this happens, when we sell the S&P 500, it's going to be less worth in pounds. There's not an awful lot you can do about this. One option would be to go for a hedged S&P 500 fund like this one from iShares. The way this helps to offset it is each month it hedges the money back into GBP. Maybe not quite the miracle you'd expect, but definitely can help ease the issue. You won't feel this quite as hard with a world fund, as your money in most cases will be exchanged into different currencies to purchase. But remember, you still do have that 60% exposure. So what are our options against a falling market and currency risk? A popular example often used is gold. You've probably heard of people investing in gold. A basic understanding understanding of it would be that people tend to trade in gold to counterbalance the stock market. So if the market goes down, then gold goes up. Gold is also seen as a sort of safe haven. It's why Putin has 140 billion worth of gold stockpiled. So he always has worth, no matter what happens to the currency. Although currencies are now working together to ban Russian gold in an attempt to make things even harder for him. Now you might expect, with the S&P 500 being down over 20% year to date, gold would do the opposite. Go up. Well, so far this year, gold is down 8%. The gold price did spike high early this year with fears of consequences of Russia's invasion of Ukraine. But since then, other market conditions have hit it, primarily the Fed. Because the Federal Reserve has been hiking interest rates to bring down inflation, which still remains high, it's pushing the US dollar to its highest levels in the past 2 decades. The interesting thing about gold is it's a good bet against currency fluctuations. If you bought £1,300 worth of gold in November, it's now worth £1,450. So if you thought the pound was going to weaken, gold would be a really strong way to hedge against it. The good thing, however, about gold is it's an asset. It's almost guaranteed that if you hold it long enough, it will go up in price. For example, if you even think there's only so much gold on the planet, as the population rises, people still want the gold, but they're going to have to pay more money for it. So holding gold as part of your portfolio is never a bad idea. You can see there's a general theme here with the dollar being so expensive. So what if we look more inward, at good old Britannia? Well, there's one obvious benefit here, right? We don't have to pay those extortionate exchange rates to the USD. But there's one thing that's really making the UK so hard to invest in at the moment, which is our government. Now, admittedly, it's not easy. We're in such a bad situation that any decision is going to be unpopular, but there seems to be a cycle of them not properly explaining things. What's the true long-term plan to stimulate growth? They seem to be doing a very poor job of explaining it. Growth and the strength of the pound is the one true thing that we need to happen here in the UK, which seems to be what their plans involve. And if they're able to execute it, the FTSE is a brilliant investment. Partially the 250, which is a more accurate representation of the UK market, which is down 20% year to date. The problem is, however, is it going to be a rocky road before we get there. I'm not convinced if we buy at this moment in time that things aren't going to get worse before they get better. Property, which people always say there's nothing safer than investing in bricks and mortar, is now very expensive with super high mortgage rates, which may present some buying opportunities in the next 6 months as people simply can't afford it, but it will likely have a large knock-on effect on UK spending. The most attractive option in the UK now, in my opinion, has to be dividends. Dividend rates are very high at around 10% in a lot of cases, and this is what I think is going to be your best bet in the year going forward. Dividends from well-established companies that have previously weathered recessions that you're able to collect a return from each month, which could also help with some additional income if you need it to cover the increased cost of living. While I still expect some of these companies to come down, and remember, if the US market falls more, it will have an impact on the UK too, at least you've got dividends to offset the losses. But I would take a more considered approach and buy into them slowly, so you're buying at the lowest points. And of course, you've still got the option to just continue to buy your All World Fund or your S&P 500, which is no problem if you just accept it's all part of a long-term plan. But just perhaps accept that at the moment it's not too good of a deal. Alternatively, keeping your cash in a savings account with a high rate for the next few months and seeing what happens isn't a bad option. Rates will likely continue to go up. I'm hopping between accounts. I've already moved from 1.85% at Chase Bank to 2.75% at Santander, and I'll continue to do so as new deals crop up. Speaking of deals, I have managed to get CoinJar to give you £10 of free crypto of your choice when you use the link down below. If you haven't used them yet, they're one of the most secure, reliable providers and the only one I use. And you can get a free crypto card which you can use to spend the crypto in real life, which is pretty awesome. I'm going to continue to secure as many deals as possible, whatever I can get to give to you guys to help you out. I hope this was useful, as I really like to keep things transparent and share what I'm thinking. If you're worried about how your portfolio is looking, then do check out this video where I talk about why a stock market crashing is actually very good.